Hey there, welcome to the channel. So today, going to try to look at where the charts are at for the upcoming week here. Okay, so we got cat cam in the house here. There's my cat Clyde. If we take a look at what SPY did, we can see that looking at the weekly, this thing had, really, yeah, kind of got kind of truncated here. It had let me go to here on a weekly here. So, okay, I'm on the weekly. Let's see what this did. Yeah, so this week was kind of not as big as the previous week. So yeah, going back to the weekly chart here. Okay. Yeah, so I mean we had another up week. So if you look at it, we, started the week before, had really strong week here. Volume dropped off, whatever, but like it's important, it's getting above the important moving average here. So here's like the 50 week moving average. It's equivalent to the 200 day, and you're almost in that position. So we'll look at the daily chart here, and we have the 50 in the solid line here. The purple and the blue line is the 200 day. So you have this death cross over here, and this thing is, now it's like, okay, well, now it's going to start work. It looks like, well, we'll see. I mean, we'll see. It's going to take some time for this to start working its way back up. But we got a back above the moving averages. So we're back above the 50 and we're back above the 200 day, more importantly. So now if we kind of look at where this is going, this market has got resistance here at this 455 level, which is coming in from over here. So we'll see what happens this week. It is kind of in many ways a very pivotal week, right? Because if you take a look at this thing, if this stock market comes out and it breaks above this, above these previous highs over here, I mean, that's definitely we're back in business basically. So I find it, of course, very hard to believe that the market's going to do this, but the market's doing what the market's doing for whatever reason it's doing it. So yeah. Now on the Dow Jones Industrials here, this is a little different. See, we're not above the 200 day. We're bounced off the 200 days. So you can see how these averages are diverging a little bit. So the Dow Jones Industrials kind of seems like it's got hit a little more. Now, it's not just in percentages, but it's in terms of where it is in the trend. So the thing is, we have a little bit more to go, to get to that previous high. If remember on the SPY, we're very close to it. So it's definitely got like a little more work to do to get back above the most recent highs. So that's what we have with that. And then if you look at the Qs, see what's going on with this thing. The Qs are actually in many ways doing a little better here, because once again, it's like, well, what's going on? You have these highs. If it can get back above this 370, and it's fairly close to it. So it's kind of interesting. So the SPY and the Qs are like in a similar situation, whereas the Dow Jones is like a little more maybe lagging-ish, in terms of getting back above recent highs to kind of get itself back on track to restore, the uptrend. So, you can see here on the Qs. Okay, so the Qs are, in terms of the major moving averages, we're still not above. We're not back above that. And then, but on SPY, we're kind of above the 50-week moving average. So it's kind of interesting how these are going. They all kind of move a little different from each other. And then the industrials here can't really quite get above that. So that's kind of interesting there. Cat went away, so I'm going to leave that. The other thing that was going on really in the market is this, looking at the 10-year. Man, look at that thing. So this is on a weekly. So look what happened last week on the 10-year. That's just a huge move in rates. Let's see, it went up 16% in one on the 10-year. The yield went up 16%. That's a huge move. That's just incredible. So, what's happening here is, obviously it seems like the market's trying to catch up to where the Fed is going. And so you have this situation where it's going to have these up weeks and these down weeks. And this is one of these big up weeks here. Yeah. Yes, stay over there and be happy. Yes. Okay, the cat is back. Okay, so Yeah, so this is really interesting. So this is like the 10-year just moving rapidly, incredible move on that sucker. That's just a big move for a week. That represents really significant losses in the bonds. So, the counter to that is looking at the price of the TLT. Now it's very interesting too, because look how this works here. If you look at the TLT, TLT put in a new low. So here's what's happening here is that, you know, the rates are going up. The Fed is pushing up the rates. They're pushing up the very short-term rates, like literally the effective funds rate. The funds rate is like the overnight rate. So it's a very short term, but the long-term rates are apparently responding to some extent. And so this, if you look at this, I mean, this is putting in a new low. So, it's kind of interesting thing because what that means, what that means and what, you need to understand is if you have part of your portfolio in bonds, and this is, of course, sort of the thing that goes on. If you have your portfolio in some of your portfolio in bonds, then this means that that portion of the portfolio is taking losses, right? It's taking losses on principal. Now, depending on how much you paid for those bonds and how much you're getting in interest, it depends whether you're actually getting a total loss. But as it is, if you're buying those bonds or have those bonds, you're taking significant losses on them in terms of the price. If you hold them to maturity, it may not matter, right? But if you're actually buying and selling bonds, then it does matter because you're losing money on the principal. So going back out here to a longer term chart, this is the thing, going back 2003. So here you have the long-term bull market in bonds here, very long-term bull market in bonds. And so, looking at it as the flip to the stock market, you had, here's like a trend line and at one rate, and then it kind of like, let's see, goes like that. So, this thing had, just we've been in this long-term bull market in bonds and prices of bonds. And this is now, as far as I can tell, this really is a top. I mean, look at that thing at right around this 130 is where it needed to hold, and it didn't hold and it broke through. And that kind of might explain it. That explains maybe why it went so aggressively down, So what I mean by that is that if you look at this thing, and we're going to zoom out to the weekly. Yeah, see, what's happening here is, as the pricing of the bonds were coming down to this support level, it needs to hold the support, and it held it. See, it held it the previous week, but then this week it gapped below it, and it sold off. And this is kind of the thing that can happen in the market, right? So you see this when you're looking for stocks. You're looking for stocks where you're trying to get a buy point. So you might be like, maybe there was some kind of a W setup, and you're starting to come up this side, and you're looking to like go long as it breaks. And very often when these things do break, you'll have really strong days right at the breakout point, and then it'll settle off. And if it was all successful, it would go to an uptrend, right? But you have that day because this is the point where they're holding, right? So if you're betting against it, so if you're like short, you're like, okay, this becomes your place where you're gonna cover your losses. Meaning that if you're short this stock or this commodity or whatever it is, you're gonna buy to cover. So the thing is, when it breaks through, all of a sudden it makes a large move up. And the reason it makes a large move up is because all these people, all this extra buying pressure comes in. And so this is kind of how these markets kind of get set up. And so, in this particular case here, you've had some strong selling in bonds here and then here, but it just kind of, this is how things set up. And this then is how you got a 4% loss in the principal on those bonds. And you also had a 16% move in interest rates. So that's pretty impressive right now. So one other thing, let's check out. We want to check on the dynamic yield curve here. Okay, so looking at the yield curve, we can see here that, this thing is flattening out a lot. So once again, this tool I've shown before with stock charts, you can see on the right is the S&P 500, and then at wherever the red line is, that's the yield curve at that moment in time. So you can see how we have a steep yield curve at these bottoms in the market, and then we can see as how we start. So we'll pick this bottom in like 02, 03, see how a nice steep yield curve, and then as it goes up, at some point, you see how it's inverting. So the short-term rates are at a higher yield than longer-term rates. And then at some point, things go to hell in a handbasket and it goes down. And once again, I had a video on this, but the reason is because it's the Fed pushing those rates up. When you get to this point over here, why in the heck would the short-term rates go up so high? They go up so high because the Fed is pushing up those short-term rates, and they are able to have some effect on it. And the long-term rate is not responding to that. And then so where we are right now is we are pretty flat. Interesting to note, and everyone's looking at this intently right now, but you see here's the 30. So the 30 and the 20 are inverted just slightly, right? They're slightly inverted like that. And then what's interesting too, everyone likes to look at the 10 and the 20, and that is not inverted. But what's interesting is the 7-10 is a little bit inverted. So 7 and 2 are pretty flat with each other, but the 7-10 is also a little bit inverted. So we can see that this is flattening out. And then you can see what's happening. Here we are. It should be at about 25 basis points in the Fed. So now let's imagine what's going to happen here. Going forward, the Fed is going to come out over the next, every 6 weeks, they're going to raise by 25 basis points. So they're going to be tick, 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 tick. At some point, they will get to, who knows? I don't know how far they get, but let's say they get to somewhere like here, like 2% or something like that. So as the Fed is raising rates, at some point, they're going to get to a point and they're probably going to break something. But you can imagine at that point, like right now, there's sort of this indication that they could go all the way to 2.3% without totally inverting it, right? But if they go higher than that, then they're going to really invert and screw up this curve. But the thing that is happening right now is that right now you're seeing these inversions and they've done very little. So what's happening is the market is already inverting, and they've only moved like a 25% basis point. So my point is that as this goes on, these short-term rates are going to come up. The expectation would be, and this is not a prediction, this is not financial advice, but the expectation is that, hey, given that every time the yield curve inverts as the Fed goes on a rate raising cycle, that this kind of inversion that you're seeing, this would kind of pick up and continue to occur and get worse. So that is it for the main parts of the market. And so what's our setup? I mean, gee willikers. So if I look at the SPY, it's like, okay, if you're a long-term investor guy, it's like you just kind of hang out, right? You should just be hanging out because, we're back in the uptrend. But I just have that feeling that we're getting set up in some way, because with interest rates going up like this, it's in the yield curve pushing towards inversion. It just seems like it's going to be an issue. It will. The Fed at some point, every time you look at a chart and you go through it, it's like, okay, what happened? The yield curve inverted because the Fed pushed interest rates up. They push them up too fast. Something goes crack, something breaks, either in the economy or in the stock market. Very often both, right? Very often the stock market is a leading indicator of economic activity, cracks at some point before you go into recession. We also have the dollars continuing to move up right now. Dollar and gold kind of moving up together. Really interesting. And that's fine. And that's what we have at this point.